Welcome to the Finance Accelerator simulation. My name's Will DeLucy, co-founder of the firm, and it's my pleasure to take you through some of the core concepts you will need in order to perform well in the simulation exercise. Before we get onto the theory, let's have a quick overview of the simulation itself. There will be 2 rounds, each of 30 minutes when you take the simulation. In one of those rounds, you'll operate as an investment bank team, taking roles of a sales trader and a market maker as you facilitate client flow. In the other round, you'll be operating as an asset manager, trying to reach your objective of maximizing return using the investment banks to execute your trades. You'll see both sides of the industry and really get a good feeling of what area of the industry would best suit you when you start applying for your roles in finance. Talking of the financial industry, let's have a top-level overview and look at what types of companies exist. We tend to divide companies into 2 very broad areas. On the buy side, you have companies like hedge funds, asset managers, pension funds, and private equity companies, and it's really their objective to try and raise funds from investors and invest those funds to generate a return. Now, in order to invest those funds and generate a return, they need to use the services of the sell side. So we call the sell side because companies such as investment banks, interdealer brokers, or research houses, they are selling a service to the buy side, okay? So services go from the sell side to the buy side, and for those services, the buy side pay commission and fees. So you have the sell side of the industry selling a service to the buy side of the industry who buy that service. Very simple. When we look at an investment bank in particular, it's important to note that a bank can be divided into 2 general areas as well. And actually, depending on which area you apply for in your future roles in finance, the type of role that you end up doing will be incredibly different. So let's take a look at the global markets division first of all. This is the area of the bank where you would expect to have a large trading floor, lots of noise, lots of movement. It's very fast paced, and first of all, one of the main people you'd certainly hear on the trading floor would be the sales traders. These are the candidates who are speaking to clients all the time, talking about market news or market events, trying to offer a service to the client of giving their client access to markets. So remember, it's all about selling a service. The global markets division is selling access to markets, and it's the sales traders who speak to the clients day in, day out to try and find out what type of access to markets do their buy-side clients want. On the more quantitative role then, we have structured products and research and market makers and quants. So it's the sales traders and the prime brokerage arm that will be speaking to the clients, and it's actually the market makers and the quants and the structured product division that will be creating prices for those client orders and managing the risk for those client orders. All of things that you'll be doing when you take the simulation. So in this simulation, you're going to be covering the sales trader role and the market maker role. If you take further, more advanced simulations with us, you'll be looking at structured products and quant and prime brokerage also. Fundamentally, therefore, the sales traders and the prime brokerage, they're speaking to the clients, trying to find solutions for their clients, building a relationship with their clients. So if you're this type of person, then you tend to be very good with people. And the market makers and the quants and the structured research, these are more, if you like, mathematical individuals who are very good at working under pressure, analyzing risk and dealing with numbers. There's the global market side of the investment bank. How about the investment banking division? Well, if you were to say to me you wanted to work for an investment bank, or if you wanted to be an investment banker, very often I'd actually assume you meant this side of the division. Rather than dealing with markets all day, this is actually more about really consulting with clients, providing them with access to money from debt capital markets, equity capital markets. It's more corporate finance heavy, different areas of the industry focus. You might be helping a firm merge with another firm or acquire a target company. Very, very corporate finance heavy, as I've said. And really, you're trying to help clients raise capital here through debt or equity. So a company might go on the stock exchange, so an IPO, you're helping that firm raise money by selling shares. Or here with advisory and more corporate finance service, you're helping your clients execute and identify transactions. Okay, 2 very different sides to the investment bank. And here on the global markets division, you could say it's faster paced, it's very market driven. You need to be involved in what's going on in the political world, what's going on with the economic data that's due out. And on the investment banking division, it's more deal focused, where you might have a project lasting a number of weeks helping one particular company acquire another company, as an example. Okay, so two sides of the investment bank, global markets and the investment banking division. When we look at an asset manager, well, there's different types of buy-side firms, asset managers, hedge funds, private equity, venture capital here, and they differ between them in how they trade, what they trade, but we're going to focus on asset managers at the moment. So when we take a look inside an asset manager, we're looking at a fund manager as a potential role, or also known as a portfolio manager. We're looking at a research analyst, for example. We're looking at an execution trader and sales and distribution. Okay, so these roles come together in order to try and meet their investors' objective of making a return on their investment. So fund managers, you'll be deciding on what assets to buy, what assets to sell, using the information provided to you by the research analysts. Execution traders is a really important role for large block trades. That's something I'll be discussing a bit later. But it's up to you to try and find the best price for the positions that the fund manager has dictated. And of course, vitally important, without sales, without distribution, then actually you've got no investors' funds to work with. So the sales and distribution team will be putting the word out there about just how great you are as a fund manager, just how great the fund is, and trying to convince different clients, such as high net worth individuals or pension funds or charities, why they should invest their money with you and why you're going to do a better job than other asset managers out there. Okay, so we've covered the buy side, we've covered the sell side. You know they're two different types of companies and you know they work with each other. But how do they work with each other? What's the flow between the institutions? Well, let's look at this as an example. An investment bank research team might, for example, I don't know, look into an upcoming election, and they've got evidence that actually it's more likely that a certain politician might win than another. And if that happens, and if they think this research is very valid, they might distribute that to a portfolio manager or to a buy-side company who might have exposure in, let's say, that country's currency, okay? Or they need to hedge that country's currency. So the portfolio manager and the strategist will review this research and they might decide, okay, we really need to hedge our exposure to the US dollar, for example, and they will speak to the execution trader in order to execute a very large trade in that currency. Okay, so this is the flow of communication, the investment bank providing research to the buy side deciding to execute on some of that research, and they give that execution order to the execution trader. Now, it could stop here. If this was a very small trade of a very low size, the execution trader here could simply execute the trade on the screens they have in front of them if it traded on an exchange. All details I'll cover in a moment. But with many trades, this is as far as it might go. As I'll discuss though, and as I'll show you, with larger block trades, it's absolutely the right thing to do for the asset manager to contact a sales trader in the investment bank and to speak to that sales trader and say, listen, I've got this really large trade I need to execute. It's of X amount of size. Can you make me a price better than what I would get in the exchange without you? And this is what the investment bank's doing. They're providing access to markets, okay? So the sales trader, who's got a strong relationship with the trader on the buy side, would speak to the market maker. Now remember, that's the person that's good with numbers. That's the person that's good with managing risk and working under pressure with markets. The market maker would provide a price to the sales trader for the client to execute that trade. Okay, and so let's say the client sells US dollars, for example, then the sales trader and the market maker, they would take the other side of that trade, as I'll explain. Now, after that exchange happens, obviously the investment bank now has a position of risk that they might not want. If it's an order-driven product, they'd be able to unwind that risk on the exchange, okay, and then try and get out of any exposure that they have, and hopefully holding on to the commission that they've made through helping the client execute the trade and not losing any money when they exit the trade. As a reminder, as the investment bank provides the service to the asset manager, let's say if the asset manager wants to buy, then the investment bank will sell. They'll take the other side of the trade. So the investment bank will now be short, and in order to get out of that risk, they will buy it back in the exchange. Okay, so the net result of that transaction would be that the asset manager has the position that they want to have on, they're already long now, and the investment bank, after they've bought back that short position in the exchange, they should have no position of risk left on. That's going to be a really key thing that we're going to look to measure in the simulation exercise when you take part. Okay, so how do you make a price? Good question, and if you've never done it before, you definitely need to know now. One of the reasons for making a price, and really why investment banks provide this service to asset managers, is because of something called liquidity. Here, we're looking at the market depth of a particular product. I've got prices 101, 102, 103. These are all offers, which are above the market, and you can see that the volume of all the different sellers at each price equates to 1,000 or 450 or 750. So these are the prices, and this is the volume of the offers. So if I wanted to buy this product, I'd have to buy from anyone that's willing to sell it, and you can see I can buy 1,000 contracts here at the price 101, or I can buy, if I wanted to buy 1,500 contracts, I'd buy 1,000 here, I'd buy 450 here, and I'll just have 50 left to buy here. But already you might be able to see that with a large trade, I'm moving the price higher. Okay, and that's definitely something that an asset manager will want to avoid. It gets expensive. With a small trade, if I only wanted to buy 50 contracts or 100 contracts, I can just buy them in the exchange. No problem at all. Or if I wanted to sell, if I wanted to go short this product, I can sell it to any of these bids where they're looking to buy. Okay, you can see there's a bid at 100, a bid at 99, and a bid at 98. And this is what I'd call market depth. This is a deep market in comparison to this market. Here, you can see the volume is much, much thinner. There's not so many people, not so many firms, not so many algorithms looking to sell at each price here. Okay, so it's very thin. There's thin liquidity. Now what that means is, if I'm the asset manager and I want to buy 500 contracts of this product, well, I can only buy 23 here, and I can only buy 3 here, I can only buy 9 here, and I'm going to lift the offers. And it's going to be really expensive for me because I'm nowhere near going to get filled at 101. Even though the reference price says this market's trading at 101, the actual price I get filled on, so the actual price where I end up buying, will be a much, much higher average price, maybe 150. Okay, so I'd be paying a 50% premium, which would be a disaster. And that's when myself as a buy side, whether I'm a hedge fund or an asset manager, I would actually call up an investment bank and say, I don't want to go to the exchange to execute this large block trade. I want you to make a price for me. Okay, and it's going to be the objective of the investment bank to try and make a price better than what I would get on the exchange without that investment bank. And this is really summarized in this this chart here of making a price. So here, let's say we've got the reference price of 150. If I just wanted to, so an asset is trading in an exchange at $150. If I just wanted to buy 1 contract or 2 contracts, for example, no problem at all. I can go directly into the exchange and I can buy, and I'm not going to move the price because my trade is so small. I'm only putting a small trade through, so I'm not lifting the prices very much, or I'm not, if you like, pushing the price down if I'm selling into the bids, if I'm hitting the bids. So that's fine. But if I wanted to do a really large trade, okay, actually, because of the liquidity, I'd get an average price of $170 as an example. Or if I was selling, I might get an average price of $130, which is really far away from the reference price. I definitely want to avoid that. There's 2 ways I can avoid that as a buy-side company. One way, and you've probably worked it out, is actually I could go into the exchange like this, and rather than buy 500 contracts all at once, I can just buy 1, buy 3, buy 5, and I can slowly enter the trade into the exchange. But there's a few negatives of that. First of all, it's going to take me a long time. Secondly, everybody in the exchange can see what I'm doing. Thirdly, the price might move up in that time anyway. And fourth, I actually don't know where I'm going to get filled. As soon as I start doing it, the price can move, and it's a very unreliable way to execute a large trade. So I'd much prefer to pay an investment bank commission and say, look, I've got this large client order, I just want one price, I want to know what that price is, and I'll pay you a commission, and ideally it's got to be a better price than I'd get in the exchange without you. That's when an investment bank will say, okay, sales trader would speak to the market maker, and the market maker would look at the pricing, and remember, the investment bank, they're going to have a lot more tools available to them to give a better price than the exchange. It might be, for example, I've got other clients that can take the other side of the trade. I know how to hedge my position of risk. I might already have a position that can help me make a better price for you. All things that we'll discuss as we go through the more advanced simulations with Amplify. But here, the reference price is 150, so as a bank, if a client is asking you for a two-way price, I'd very often not tell you whether they want to buy or sell, because they don't want you to use that information against them. So they might say, make me a two-way, or make me a bid and offer, give me a menu, depending on where you are in the world. And I don't mean give me a menu, I'm hungry. A menu means make me a bid and offer. So you've got 148 on the bid here and 152 on the offer. And this is where the client can say, okay, this is interesting. I know the price is 150, but I want to buy 500 contracts. I know if I buy 500 contracts in the exchange all at once, I'm going to get a really bad price and it's going to go all the way up to 170. But now I've asked an investment bank and they're coming with the price of 152. Well, that's way better than 170 for me to buy at the bank's offer. Therefore, it's absolutely worthwhile me paying that bank commission so I can buy at 152 rather than 170. Now, when that client has executed the trade and they've clicked buy, remember the bank sells. So if the bank had no position on beforehand, this bank is now going to be short at 152, which at the start, that looks like a really good deal because the reference price is just 150. So not only did the bank make money from commission, but their P&L is also going to be showing a positive print here. But remember, the bank is now short at 152. They've sold at 152, so they're going to have to buy it back. And they'll be buying it back at 150, right? So, but what happens when the bank starts buying it back? They'll buy it back, and the price will start moving. So the challenge for the market maker is to try and get out of this position of risk and not lose more money than you made in the commission that you took from the client trade. Okay, I hope that makes sense. We want to see you in this simulation as a market maker. When you're working on the investment banking side, you must be making a price much, much closer to the reference price than the client would get in the exchange without you. Otherwise, they simply won't trade with you. For those of you who go on to take our more advanced simulations, we're going to be talking to you a lot about how to skew your bid and offer to reflect a bank's acts at any time. It's a really key role of a market maker to adjust this bid and offer to really incentivize a client to trade in the way that the bank wants them to trade. It's too advanced for the Finance Accelerator, so just for now, as a market maker, remember, try and give a bid and offer better than the client would get in the exchange without you, as close to the reference price as possible. But not too close, because if you go too close, you'll end up losing money getting out of the trade, losing more money than you made in commission in the first place. Okay, last slide on making a price then. Investment bank, you're the price maker. When you're operating as a market maker, you'll be sending a client a bid and an offer. So here we've got an example where the reference price is 100. The bid will always be below the reference price, and the offer will always be above the reference price, okay? So bid low, offer high. The bid is where the bank buys. The client sells into the bid, okay? And the offer is where the bank sells. The client buys into the offer. Let's go back to that previous chart just to make sure we've got this absolutely right. Here's the reference price as an example, and the bank surrounds this reference price with a bid and an offer, okay? That bid is where the client sells, and the client is happy to sell at a lower price than the reference price for a large block trade, because if they didn't go through the investment bank, they'd have to sell all the way down here at 130. Okay, so the client will sell at the bank's bid, which means that's where the bank buys, because the bank does the opposite to what the client does. Here at the offer, this is where the bank sells. Why is that? Well, because the client could go into the exchange and get an average price of 170, but instead they're able to buy at a much cheaper price. They understand it's higher than the reference price. It's a large trade. It's going to be higher than the price that they see in the exchange. So the client buys here, and that's where the bank sells. Remember, the bank always does the opposite to the client. Okay? So the market maker will always take the other side of the client trade. One way to look at it is this. If you're the one sending the price, if you're the bank sending the bid and offer in the simulation, you're making that price. You're a market maker. Okay? And when you're a market maker, you buy at the bid and you sell at the offer. When you're a price taker, you're receiving that price. You're on the client side of the trade. You're receiving that price. So you're selling at the bid and buying at the offer. Something to get used to in the simulation. It's going to take you a few times to practice it, but I'll tell you something very clearly. If you're making bad prices, the clients won't trade through you. You'll get no commission, there'll be no flow, and you'll perform quite badly. So if you find during the simulation that no one's really trading with you, try and make your bid and offer much, much closer to the reference price, and then you'll try and convince the clients to put their business back through you again. So investment bank objectives. As a sales trader, maintain good relationship with your clients. Maximize your commission. Well, they're sort of one and two in the same, aren't they? If you do have a good relationship with your clients, they're going to come back to you. And you'll see this as an asset manager in the simulation. It's quite inefficient to keep on going to lots of different investment banks and asking for lots of different prices. In the later simulations, you'll be using an electronic quote board. But in this simulation, you know, it's more vanilla than that. You're just going to be able to go to the banks and ask for their different products. Once you find a bank that's good, stick with them. Okay, and that's down to being a good sales trader. So a good sales trader for an investment bank would always have clients come back. It's like anything. You're providing a good service, so the client comes back. The more the client comes back, the more commission you're going to make. Okay, so that's the sales trading. As a market maker, you've got to make good prices and try and get out of risk. So what you don't want to have as a market maker or working in the investment bank in the simulation is lots and lots of positions built up on your order book, okay? You don't want to have all of this risk. You're not a hedge fund. Volcker rules, certain regulations should push you against that anyway, more of that later. But as an investment bank, I want you to focus on making money out of commission and getting out of risk. Making money out of commission and getting out of risk. I don't want you to hold on to lots of big positions of risk. That's not what an investment bank does. You're working on the sell side and you should be driven to sell a service to your buy side client. Okay, speaking of your buy side client, let's have a look at asset managers and asset allocation. First of all, you'll be managing a portfolio of 20 million, okay? It's a global equity long only fund. You've got a client risk profile moderately high. And one of the things about this simulation is you'll notice that the wide spreads in the exchange will really demand that you seek investment bank trades. Okay, so I want you to go through the investment banks in order to execute your trades. The exchange is there for you, but you'll find it's very expensive due to liquidity to do so. You've got a stop limit of 500,000 for any one position, so we really don't want to see you break that stop loss limit. And the way the simulation is going to work is you'll have 30 minutes of data that covers 2 quarters of news and events. So you'll have some research documents before the simulation. Make sure you take a look through those as fast as you can. The year's going to start effectively, and you're going to trade through 2 lots of 3 months. Okay, so you've got 6 months worth of news and data that impact the assets that you're going to be trading. And it's your role as an asset manager to try and allocate your assets according to where you think the highest return will be had, and also obviously avoiding losses whilst you can. One of the main objectives of an asset manager is to try and beat the benchmark. You might not have heard that before, but it's a very common thing in the industry. In fact, the most popular benchmark and well known is the S&P 500 index. Why would an asset manager be tasked with that? Well, as an investor, I know that I could just invest in the S&P, invest in the US stock market, so the S&P 500, with very little fees, with no hassle. That's something I can do myself. I don't need an asset manager to just follow the US stock market. I can do that. So if I'm going to be paying an asset manager, I want to know that they can at least outperform something that I might be able to do without them. Okay, so your benchmark is going to be the world index following the different companies that are available in this simulation. Alibaba, HSBC, BP, Microsoft, Volkswagen. It's a very diversified portfolio, both globally and industry-wide, but you can see that the benchmark is weighted equally between these products. When you start the simulation, you'll have some weighting, an equal weighting across the different products, but it's up to you to try and get close to the benchmark weighting. You know, your client wants you to be close to the benchmark, but not exactly the same, because they're paying you to outperform the benchmark. So if bad news comes out about Alibaba, for example, you might reduce your weighting to 10%, let's say, and you might increase your weighting in the others. So that's what we want you to do. You're really to hold a diversified portfolio as an asset manager. You'll be pushing your trades through the investment banks, but I want you to react to the news and tweak your portfolio accordingly. Okay, your objectives. Beat the benchmark. Number one, what is your client paying you for if you can't beat the benchmark? Maximize your return on investment. Get the best price from the investment bank. What will absolutely help you as an asset manager is if you find an investment bank that's fast, that's efficient, and gives you good prices for you to execute your trade. That will make a huge impact on your performance, and also make sure you maintain your risk parameters. 500,000, any products, that's your maximum loss. Don't even get close to that, would be my advice. Okay, so let's have a look at the simulation and assessment itself. As I've discussed, the simulation will take 2 rounds of 30 minutes. You'll be swapping roles. I don't know which one you'll start. You might start as an investment bank. You might start as an asset manager. I don't know. It's going to be equally split for the session that you have. But make sure you do have a look at the research before the session starts. The trainer will deliver that to you just before the simulation. How does the simulation look? Well, here's a quick screenshot actually. I mean, it's a very, very detailed platform. This is the same simulation used by the largest financial firms all over the world to get their candidates desk ready. So you'll actually be performing the roles that some of the largest investment banks deliver to their sales and trading team just before they start their job. Okay, it's very involved, it's very intense, but really you'll have the best experience if you just go with it with open eyes. You've watched this video, watch the how to play videos, and you'll have a fantastic time. What will we be measuring? Well, we'll be looking at different metrics as you perform the different roles as either an investment bank, market maker and sales trader, or as an asset manager. And this is where I think our technology gets really interesting. We're just covering the basic roles here in the Finance Accelerator. We're not going too deep into theory. We're keeping it simple. But here's an indication. On the market side, we're looking at your commission. How much money do you make as a sales trader? Your fat finger count. You might not have heard of a fat finger before, but it's a common phrase for if someone makes a mistake on a price, for example. Ideally, you don't want to make any of those. Number of trades, that gives us an indication of your output. How many client trades are you sending through? How many deals are going through? And then also your risk management. When you're executing client trades, and as a bank you've taken the other side of that position of risk, how long does it take you to get out of that position of risk? Remember, as an investment bank, ideally, you don't want to have too many positions of risk on at any time. You facilitate a client trade and then try and get out of that position of risk. Okay, so we're looking at 4 different metrics for you as the investment bank global markets team. Okay, asset manager, we're looking at your return on investment, obviously a key priority. We're looking at your execution score. So remember, the reference price isn't the price that you'll be getting for a large block trade, but if you know which bank is good, if you're effective in your role, you should be able to get prices quite close to the reference price, and that's really a key thing for an execution trader. That's definitely what we'll be measuring. And obviously, we look at your risk management. Do you keep to the risk limits? Are you disciplined in your approach? And how well can you do in the asset manager role? Okay, well, that's it from me. It's been a pleasure to take you through this brief introduction. Please make sure that you watch the how to play video that's coming. That will cover both the investment banking side and the asset management side, and it's going to be essential to make the most of your simulation exercise. We really look forward to seeing you. It will be a live event. We'll be full of energy. Look forward to seeing you on the simulation. All the very best of luck.